Bernie Madoff, a name synonymous with financial fraud, was once a respected figure on Wall Street. His story is one of ambition, innovation, and ultimately deception. Born in 1938 in a modest Queens neighborhood, Madoff's early life was far from the glitz and glamour of Wall Street. Madoff's journey to becoming a financial titan seemed improbable. He was an ambitious young man with big dreams and a relentless drive to succeed. He started small, setting up a penny stock trading firm with money earned as a lifeguard and sprinkler installer. These humble beginnings laid the foundation for what would become a financial empire. His firm, Bernie Madoff Investment Securities LLC, was founded in 1960. It was a time when the stock market was undergoing significant changes, and Madoff was quick to adapt. Madoff's early success stemmed from his innovative use of technology. He saw the potential in electronic trading long before it became mainstream. He was among the first to utilize electronic trading systems, a move that revolutionized the way stocks were bought and sold. This technological edge gave him a significant advantage over his competitors. The introduction of electronic trading systems streamlined operations and increased efficiency, allowing Madoff's firm to grow rapidly. This pioneering spirit earned him respect and admiration within the financial industry. He was seen as a forward thinker, always one step ahead of the curve. Madoff quickly rose through the ranks of Wall Street, becoming a prominent figure in the world of finance. His reputation was built on a combination of innovation, hard work, and an uncanny ability to predict market trends. He held leadership positions on Nasdaq, where he played a crucial role in shaping the future of electronic trading. His influence extended beyond his own firm, impacting the broader financial industry. Madoff was a key player in the development of Nasdaq, helping to establish it as a major stock exchange. Known for his quiet demeanor and consistent returns, Madoff cultivated an image of stability and reliability. Investors trusted him implicitly, believing that their money was in safe hands. Madoff cultivated an aura of exclusivity, making his investment fund seem like a privilege to join. This sense of exclusivity only added to his allure, attracting wealthy and influential clients. He wasn't flashy or flamboyant, which made his persona even more convincing. His modesty and professionalism were key elements of his charm. Madoff's reputation as a financial genius was cemented over decades. He received numerous awards and accolades, further solidifying his status as a Wall Street icon. He was seen as a Wall Street legend, a man who had mastered the market. His success was the result of years of hard work, innovation, and a deep understanding of the financial world. A man who had mastered the market, Madoff's strategies were studied and emulated by many. He was a mentor to young traders and a respected figure in the financial community. This image of success and trustworthiness would later become instrumental in perpetrating one of the most audacious financial frauds in history. The very qualities that made him a trusted figure were the same ones that allowed him to deceive so many for so long. At the heart of Madoff's empire lay a sinister secret, a Ponzi scheme of staggering proportions. This scheme, which would eventually become one of the most infamous financial frauds in history, was built on a foundation of lies and deceit. Madoff, a former chairman of Nasdaq, used his reputation and connections to lure in unsuspecting investors. Unlike legitimate investment strategies, Madoff's scheme didn't involve any real trading or investments. There were no stocks being bought or sold, no bonds being traded, and no real financial growth happening behind the scenes. Instead, the entire operation was a facade meticulously crafted to appear genuine. Instead, it relied on a simple yet devastatingly effective principle: robbing Peter to pay Paul. This meant that the money from new investors was used to pay returns to earlier investors, creating the illusion of profitability. As long as new money kept flowing in, the scheme could continue. Madoff promised his investors incredibly consistent high returns that seemed too good to be true because they were. These returns were often in the range of 10 to 12% annually, regardless of market conditions. Such consistency is virtually impossible in the real world of investing, but Madoff's charm and reputation convinced many that he had a unique strategy. These promises lured in a steady stream of investors eager to get in on what they believed was a sure thing. From wealthy individuals to charitable organizations, many were drawn to the promise of high, stable returns. The word-of-mouth referrals and the exclusivity of Madoff's fund only added to its allure. When investors entrusted Madoff with their money, he simply deposited it into a single bank account. This account, rather than being used for active trading or investment, served as a reservoir of funds to maintain the illusion of profitability. This account, far from being actively managed, was used solely to pay off earlier investors who requested withdrawals. Whenever an investor wanted to cash out, Madoff would use the funds from new investors to fulfill these requests, perpetuating the cycle of deceit. The illusion of a successful investment strategy was maintained by fabricating trading records and sending out fictitious account statements. These documents showed impressive returns and growth, further convincing investors of the legitimacy of Madoff's operations. Madoff's scheme thrived on secrecy and deception. He operated in a manner that kept his investors in the dark about the true nature of his activities. The lack of transparency was a key element in maintaining the facade. He carefully cultivated an air of exclusivity, making his investment fund seem like an exclusive club. This sense of exclusivity made investors feel privileged to be part of something special, further blinding them to the reality of the situation. New investors were often referred by existing investors, creating a false sense of security and legitimacy. The trust and confidence of those already invested played a crucial role in attracting new victims, perpetuating the cycle of the Ponzi scheme. Madoff's Ponzi scheme didn't discriminate. It ensnared people from every corner of society. Regardless of their background or financial acumen, his victims came from all walks of life, drawn in by the promise of financial security and impressive returns. From blue-collar workers to white-collar professionals, everyone was lured by the seemingly golden opportunity. Retirees hoping to grow their nest eggs, who had spent their entire lives working hard and saving diligently, found their dreams of a peaceful retirement shattered. Charities seeking to maximize their impact, organizations that relied on donations to fund their noble causes, were left in financial ruin, unable to continue their philanthropic work. Universities managing endowments which supported scholarships and research saw their funds evaporate, affecting countless students and academic projects. Among Madoff's victims were high-profile individuals and institutions. Celebrities, prominent businessmen, and even well-respected public figures were not immune to his deceit. Nobel laureates, who had achieved the pinnacle of success in their fields, were drawn to his seemingly foolproof investment strategy, believing it to be a safe haven for their hard-earned money. The fact that such sophisticated investors could be deceived speaks to the insidious nature of Madoff's scheme. It was a masterclass in manipulation, exploiting trust and credibility. The impact of Madoff's fraud on his victims was devastating. Families were torn apart, friendships were strained, and the psychological toll was immense. Many lost their life savings, their dreams of a comfortable retirement shattered. Some were forced to sell their homes, downsize their lifestyles, and face an uncertain future. Charities and foundations were forced to close their doors, unable to continue their philanthropic work. The ripple effect of these closures was felt by the communities they served. The financial and emotional toll on Madoff's victims was immeasurable. The stress and anxiety of financial ruin led to health issues, broken relationships, and a loss of trust in the financial system. The Madoff scandal serves as a stark reminder that even the most seasoned investors can fall victim to financial fraud. It underscores the importance of vigilance and skepticism in the world of finance. It highlights the importance of due diligence, independent verification, and a healthy dose of skepticism when evaluating investment opportunities. No matter how credible an opportunity may seem, it's crucial to question and verify every detail. Education and awareness are key. By understanding the red flags of financial fraud and staying informed, individuals can better protect themselves from falling prey to schemes like Madoff's. In the aftermath, many victims found solace in community support groups, sharing their experiences and helping each other rebuild their lives. The strength of the human spirit shone through, even in the darkest of times. The scandal also prompted changes in financial regulations and increased scrutiny by law enforcement agencies, aiming to prevent such a catastrophe from happening again. Advocates for stronger financial protections continued to push for reforms, ensuring that the lessons learned from Madoff's deception lead to a more secure and transparent financial system for all. For years, Madoff's Ponzi scheme operated under the radar, fueled by a steady influx of new investors and the unwavering trust of his existing clients. However, cracks began to appear in the facade, particularly following the 2008 financial crisis. As the global economy teetered on the brink, investors became increasingly anxious and sought to withdraw their funds. Madoff's scheme, which relied on a constant flow of new investments, was ill-equipped to handle a surge in redemption requests. As more investors sought to withdraw their money, the pressure on Madoff and his operation mounted. The cracks in his carefully constructed facade started to widen. Whispers of Madoff's questionable practices had circulated for years, but they were often dismissed or ignored. However, as the financial crisis deepened, these whispers grew louder, attracting the attention of regulators and investigative journalists. Financial analyst Harry Markopoulos, who had long suspected Madoff of wrongdoing, had been sounding the alarm for years. Despite providing detailed evidence to the Securities and Exchange Commission, his warnings went unheeded.